Offsetting capital gains taxes with losses. So if you've sold an asset throughout the financial year and you're going to potentially incur a gain, you could, if you were eligible, make that personal deductible contribution that we talked about earlier on in the session. Or if you've got some other assets that are sitting at a loss, you could potentially sell those and incur the loss and to offset the gain, so that you don't end up paying tax on the gain. Another way that you could minimize the amount of gain is if you hold assets for longer than 12 months. Because the way a capital gain is calculated is if you've got an asset that you bought, say, for $50,000, it grew in value to $100,000, then you've made a gain of $50,000. If you haven't maintained that investment for longer than 12 months, you've just bought it in 1 month and then the next month you sold it, the full $50,000 is taxed at your marginal tax rate. So you're going to be paying tax at least on, if you've got no other income, you're going to be paying at least some money at 34%. If you hold the asset for 12 months, then it's discounted by 50%, and so you end up only adding $25,000 to your taxable income. So one way to reduce capital gains is to hold the asset for 12 months at least. The other way to reduce it is to sell some assets that are at loss, so that you offset the capital gain. So say, for example, in this case, I sold this asset, I've held it for longer than 12 months, so I incurred a capital gain of $25,000. If I've got a shareholding that's down $25,000, I could sell that, I incur the loss, and then that loss offsets the gain. It actually isn't calculated exactly like that, because you don't discount it first. You don't discount the gain first. So I'd really need to incur a loss of $50,000 over here. But basically it's about offsetting your capital gains with your capital losses, or alternatively making a deductible contribution to super to offset your capital gains. Now, one thing to be wary of here is that you can't do what they call wash strategies, and this is where if you've got to incur a capital gain and then you want to sell some shares, for example, to incur a capital loss, you can't just sell the shares on the 30th of June and then buy them back on the 1st of July. That's called a wash sale arrangement, and it's really going to be caught by the tax office as a tax avoidance strategy. But if you're genuinely going to sell the investments at a loss, you can buy them back at a later point in time if you see that they've gone down in value, or that you realize that you want to get into them again. But the wash strategies of just selling on the 30th and buying on the 1st is picked up by the ATO, so don't do that.